Good morning. I want to thank Senator McCain for joining me this morning. We have heard more and more from small businesses who are unable to access credit and unable to make payroll. Wall Street firms are about to post soaring end-of-the-year profits and bonuses, while Main Street suffers and wonders when they will have their recovery. Americans have lost jobs, lost their homes, and they've lost their savings, and they've lost retirement investment. Senator McCain and I have a simple proposal. For nearly 60 years, a firewall maintained the integrity of banking systems, preventing self-dealing and financial abuses, and limited the speculation of the stock market. Our bill would return that firewall. It would prohibit commercial banks from affiliating in any manner with investment banks and vice versa. It would prevent officers, directors, and employees of commercial banks from serving as officers or directors of investment banks and vice versa, and prohibit commercial banks from engaging in all insurance activities. It also would establish an enactive date of 1 year from the enactment of this legislation for that separation to occur. If people want to speculate through transparent, well-governed markets, they certainly may, but they should not be able to do so by putting the commercial banking structure at risk. This issue is that we have started combining companies with a mission to protect and serve the stability of Main Street with the Wall Street business model of making profit from risk. It is like putting lighter fuel onto your fireplace fire. The collapse of the banks, too big to fail, is not possible for us to survive again. But the biggest banks keep getting bigger, and with bailouts and acquisitions. While there are 700 commercial banks in the United States, just 5% of them hold over 50% of the nation's bank-owned assets. Those entities, 5 entities, hold over 95% of the risk in the derivatives market, a nearly $2 trillion market. With far much of the financial market intertwined with derivatives and credit default swaps, we must ensure that there are strong protections in place to preserve commercial banking for America's Main Street. We need to rebuild the wall of Glass-Steagall so banks will stop diverting resources to Wall Street speculation and get back to more business lending for Main Street. This bill is a first step. I just want to emphasize the first chart here shows that over 50% of the assets in America are owned by just 5 banks, and that has continued to be consolidated. The next chart shows the amount of derivatives tradings as a percentage of assets. Basically, since 2004, when the SEC rule changed the evaluation ratio from 12 to 1 to 30 to 1, basically they were able to leverage more money in derivatives from their assets. And the third chart shows that since 2008, we have had a record amount of money invested in those derivatives trading, resulting in huge profits for Wall Street, but an actual decrease in lending of $574 billion. So we've actually seen less money going to Wall Street, more money going into speculative trading. Again, I want to thank Senator McCain for being here today and joining me in this legislation. Senator McCain.
I thank Senator Cantwell for joining me in her leadership on this issue, and it's good to be working with her. My reason for joining this effort is simple. I want to ensure that never again do we stick the American taxpayer with another $700 billion or even larger tab to bail out the financial industry. If big Wall Street institutions want to take part in risky transactions, fine. But we should not allow them to do so with federally insured deposits, i.e. taxpayers' money. Paul Volcker, a well-known man and a top economist in the Obama administration and former Federal Reserve Chairman, said, and I quote Paul Volcker, quote, The banks are there to serve the public, Mr. Volcker said, and that is what they should concentrate on. These other activities create conflicts of interest, they create risks, and if you try to control the risk with supervision, that just creates friction and difficulties and ultimately fails. Arthur Levitt, the former chairman of the Securities and Exchange Commission, said, quote, "I tend to be in the Volcker camp in saying banks should either be investment banks or take deposits and make loans." That's a pretty simple explanation of what we're trying to achieve here. And as Senator Cantwell pointed out, Wall Street firms have recovered nicely, and the profits are soaring into end-of-year profits and bonuses. Main Street is suffering terribly with 10% unemployment, small business people going under, and Americans, especially in my state, unable to renegotiate their mortgages. So we have perhaps the greatest disconnect in modern times between the wealth and profits and bonuses and greed on Wall Street and the terrible conditions that exist on Main Street. We can't let that happen again. As was pointed out in these profits, how much of these profits have been extended in the form of credit to small businesses that are going under? How much of these profits have gone to help Americans who are in danger of losing their homes be able to renegotiate their mortgages? Not much. And again, as Senator Cantwell pointed out, the biggest banks keep getting bigger. While there are 7,000 commercial banks in the United States, only five, as was just pointed out, hold over 50% of our nation's bank-owned assets. What's wrong with that picture? The same 5 entities, the same ones, hold over 95% of the risk in the derivatives market, nearly $600 trillion worth. Commercial banks, as we know, traditionally used people's deposits for the constructive purpose of Main Street loans. They didn't engage in high-risk ventures. Investment banks have managed rich people's money, those who can afford to take bigger risks in order to get a bigger return and who bore their own losses. When these two worlds collided, the investment bank culture prevailed, cutting off the credit lifeblood of Main Street firms, demanding greater returns that were achievable only through high leverage and huge risk-taking, and leaving taxpayers with the fallout. The federal government has set a dangerous precedent here. We sent the wrong message to the financial industry. You engage in bad, risky business practices, and when you get in trouble, the government will be there to save your hide. It amounts to nothing more than a taxpayer-funded subsidy for risky behavior. The availability of commercial credit has tightened severely, and many small businesses don't have access to line of credit, as we know. Since January of 2008, we have seen 159 state and national banks fail. In my home state of Arizona, 5 banks have shut their doors, leaving small businesses scrambling to find credit from other banks that may have already been over-leveraged. Our proposal would be a step in the right direction to putting smaller, community-based banks on the same playing field as these big financial institutions, effectively allowing them to compete for the same depositors as the big banks. This choice and competition for consumers will result in more money staying in local community banks, allowing them to return to Main Street lending. So, clearly under our proposal, too big to fail banks would be forced to return to the business of conventional banking, leaving tasks of risk-taking or management to others. Result will be a larger number of smaller, more aggressive companies that are not so big that their failure would bring the entire economy down and would take on the risks of investment banking. This was the case with a lot of hedge funds. A lot of hedge funds lost a lot of money, but they didn't cost the taxpayers any money. So commercial banks would take deposits under our plan, manage the nation's payment systems, offer credit cards, and make standard loans. The federal government would continue to collect premiums to insure deposits. Investment houses would be free to buy and sell securities for their own accounts and to borrow to leverage these trades, multiplying the profits and risks. Today, it's time to put a stop to the taxpayer-financed excesses on Wall Street. No single financial institution should be so big that its failure would bring ruin to our economy and destroy millions of American jobs. This country would be better served if we limit the activities of these financial institutions. Banks should accept consumer deposits and invest conservatively, while investment banks engage in underwriting and sales of security. There is great anger out there. There's great anger to the level that I've never seen. When people in my state and all over this country losing their jobs, can't stay in their homes, can't get credit to stay in business as far as small businesses are concerned, and they see these obscene profits on Wall Street and bonuses. There's a great disconnect between Wall Street and Main Street in America. This legislation that Senator Cantwell and I are introducing would try to level that so that all Americans can again be part of the American dream.
Thank you.
Question.
Happy to take any questions.
Senator Cantwell, would you envisage this becoming part of Senator Dodd's larger reform package, or is it a standalone measure?
Well, Senator Dodd is working hard in a bipartisan fashion with his committee to get out a piece of reform legislation that will go to the Senate floor. Listen, I've seen what's happened in the House, and I think that there are big challenges here. So if it's not incorporated in that legislation, we would be offering it on the floor.
Senator McCain.
Let me also say we appreciate Senator Dodd and Congressman Frank's efforts, and a lot of people are involved in this, but we don't think they're addressing the fundamental part of this problem, and that is the needed separation between investment banks and traditional banking. Because then you don't have to worry about a lot of these regulators. You don't have to worry about a lot about these alphabet soup groups that or supervise the financial system in America, because the risk takers would then not be risking American taxpayers' dollars.
Senator McCain, your friend and former colleague, Senator Graham, was the one who spearheaded Graham Leach Bliley, the 1999 law that brought down a lot of these laws.
Yep.
For that. Have you talked to him about, what one of his big accomplishments and maybe the after effects that it's had?
I've talked to Senator Graham, my old friend Senator Phil Graham, many, many times on many issues. And by the way, his greatest accomplishment, I think many of us would agree, is Graham Redmond Hollings and the tax cuts of 1981 that really got our economy back on a path to recovery. But I'm sure that Senator Graham probably does not agree with this legislation, and that doesn't change our relationship. We just don't agree.
As more and more banks extricate themselves from all these bailout programs, is it becoming, and more time passes, is it becoming more and more difficult to leverage the power and to get reform through?
I think that I think the American people get it. I think they are frustrated. They know that capital is not flowing to them. They see it flowing into these unbelievable profits, and they realize that Wall Street is basically gambling with their money. And I think they're tired of it, and I think you'll see an outcry from the American people that they want this system changed.
Could I say again, I appreciate the efforts that are being made by the administration and Senator Dodd, Congressman Frank, a lot of others. But I think if you walk down Main Street or Central Avenue in Phoenix today and said, what do you think of the proposals that are coming through Congress? I doubt if you'd run into a single one that has any real understanding of what these reforms are. But if you walked up to them and said, you think we ought to have these Wall Street guys stop making money in the American casino on your tax dollars, I think most of them would agree.
Are there any particular firms you'd like to see this apply to? Any specific companies you want to apply this legislation to?
It would apply to anybody who is a merged entity, and it would give them 1 year to separate. This existed for 60 years, and it was a well thought out proposal in response to the last huge crisis that we had. And getting rid of it, I think, has showed us that it was there for a reason. And I should just say, Liz, I certainly appreciate, I know Senator Dodd is working, I thought he put out a great mark. He's working through it with his committee, and hopefully we can enhance that legislation.
The Health Bill has sort of a wind-down authority for dealing with institutions that get too big and threaten the economy.
Do you think that's not enough? Do you think that would still leave the taxpayers susceptible to?
Correct.
As long as the taxpayer is guaranteeing their activities, then it's got to be fixed. If the taxpayer, if I go to Monte Carlo and the government backs my gambling wagers, then I think I might be a little more risky in my betting patterns than if it was my own money. Thank you.
The banking committee tomorrow will vote on Ben Bernanke's nomination, and the Senate will have to take it up sometime before the end of January when his second term is up. Do you two think that he should be confirmed?
I haven't made a decision yet.
I'm leaning against, my candidate is Paul Volcker or John Taylor. I have great deference to age, I find, as I grow older. Thank you.
Thank you. Thanks.